Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, April 17th, 2020. What I'm going to do is an overview of we'll stick with just the stock market here. And as much as the charts, I just want to talk about not even so much fundamentals. I've talked about that quite a bit. We'll talk a little bit more about that, but more so human psychology and the perennial relationship between emotions and major moves or tops and bottoms in the stock market. So, what's prompted me to do the video, logged on this morning and saw an unusually large chain of comments in the last post. I think it was the last post from yesterday. Pretty much to me, there's different mix, and I'm just kind of generalizing, but most of those seem to be very capitulatory, people who were maybe on the same page as me on the site, thinking this is a bear market rally, or at the very least, even if not a bear market rally, a bounce that is getting a little too frothy, a little too overdone, and has another correction coming. Again, whether we go on to test or take out or even move way below the recent lows, it's almost moot, because as an active trader and as an adaptive trader, if we do go down that far, then if the charts tell me to stay short, or I try to wear many hats here too, and this is where I confuse people. I'm a very active trader. I can trade sometimes dozens, literally, several dozens trades, 2-3 dozen trades in and out, trading futures, other things like that, bouncing off levels. But then I also wear a hat of a swing trader and investor, and I try to, for the most part, and I've said this, and it got a little confusing in the last few months, that the front page posts are typically geared towards swing trading and trend trading. It's not day trading, active trading. But what had happened back here is we were having such big moves, and down to lows and up here, that you were getting returns and price targets hit, a 5+% in a day, maybe 10% swing trade targets being hit in 1-2 days. That effectively, again, the market was, described it back then, it was like swing trading or investing with the fast forward button hit 10 times. So you had such big volatility, you were getting the same gains that you would on a swing trade that might normally take 3 weeks or even 3 months on the indexes, but you were getting that in just a day or 2 or 3 days. And so again, I tried to make that clear, if you're especially new to the site, that look, that's just the nature of the market. We're going to take these profits and run. But let me get back to what I wanted to talk about here, and that is kind of where we are in the cycle, where I think we are. And this is I'll start here because we're on this chart. SPY official trade stops are based on a daily close. Remember, I added this target recently, fourth target, and so that's it right now. Stops stop number 2, which is, again, if you're targeting T3 T4, you can allow a wider stop, and that's based on a daily close above 286.08. Or stop 1, if you're only looking for quick pullback trades, we already took that out. That's based on a daily close above 279.09. But again, it's still an active trade based on the final targets and the maximum stop. Now, what I wanted to talk about again on those comments where, and I agree, a lot of them. There's a lot of things that made sense there, especially the fact that has this rally gotten probably a turbo boost, or a big part of it due to there's not even a word for it, enormous, incredible amount of liquidity and backstopping the Fed has put into this market. Again, it's unprecedented. They blew away what they did in 2008, and at the time, that was unprecedented. So we're in uncharted territory. I've said that, since we're going on the way down with the economy being shut down. Not so much with the stock market correcting. What made this one different is the shutdown in the U.S. economy as far as any other time in history. Never seen anything like that before. I use the analogy of World War II and Pearl Harbor getting bombed. I mean, horrible incident at the time, but the exact opposite happened. It fired the U.S. up. Everybody went to work. Men went off to war. Any able-bodied males, and most of them, and those that weren't were home, designing planes or building them in the factories. Women went in the factories, built planes, tanks, guns, and so that's productivity. That's the exact opposite of what's happening now. So again, there's no even close second, there's or parallel to what's happened recently. So my fundamental outlook hasn't changed one bit. And as I said, you can snap your fingers, Corona can go away today, and I don't think that justifies the market being going to new time highs, because a lot of things have been broken, and Corona's not going to instantly go away. We know that. At best, we're going to see, as I described, I said many times, what I call a slow reboot to coming back online, not a hard reboot where the economy instantly comes back online. In fact, let me see something if I have it here. I can't find them. Somewhere I had saved some pictures. I was going to put up and I still may put it up, a post. When are things back to normal? And what I did is I just downloaded pictures of a crowded sports stadium, a crowded restaurant, crowded airport. In other words, the day things are completely back to normal is the day that you want to go to your favorite restaurant, and you either have to call to make a reservation, or you're going to show up there and they're going to tell you there's a 30-minute wait, and they're going to give you one of those little coasters that flash when you're ready. We are very far away from that. So while this isn't complete Armageddon, we're seeing a lot of tech stocks and other companies, especially tech. That's the big one that I think has probably as big of a shoe to drop on the next leg down as the S&P 500, maybe even more, because I think there's a lot of I've already talked about that, the fundamental impact of a tremendous, one of the sharpest drop-offs we've seen in consumer spending in history. So like I said, people are buying toilet paper and hand sand. They're not buying they're not upgrading their iMacs and their phones and PCs right now. So that takes a little time. The market isn't seen that yet, and so at the very least, there's going to be some drop off. Now, how big? That'll be yet to be seen. All right, let's talk about the charts. Let's talk about human psychology. So here we are. As I mentioned, this is the kind of bigger picture on the daily chart. You have a big rising wedge pattern right there. Trend indicators still bearish. PPO signal lines still well below here. I'm talking the longer and intermediate term trend indicators. The shortest term trend indicators are obviously clearly bullish. So you got to separate that long term and short term. And then as far as let's talk about capitulation and things like that. So let's go back here. And no, that's update. That's today's post. Let me find. Let's see what I want to show you. Oh yeah, here we go. Okay, so the market bottomed back on. Let's go back one more time to the charts. Market bottomed back on March 23rd, right? So March 23rd was the bottom. Heading into March 23rd, and before that, for probably, I don't know if it was a week, a few days, not much more than that, I started making it pretty darn clear that, hey, I didn't know what's going to happen. The system could break, and I warned of that. Said I didn't think it's going to, because right now we'd be in financial Armageddon if the system broke. The system started to break, make no mistake about it. That's the money market funds. Fed came in and shored up the money market funds, repo agreements, pretty much everything in the debt markets. And that's when I say the financial markets are going to break. It's not so much how far the stock market goes down. That is part of it, but it's the banking system, the large banks, and just the whole machine that we call the financial system, which again, credit markets are the lifeblood of it. That's the heart, the circulatory system, even the freaking nervous system is what I'm trying to get at. The brain and the nerves, everything else. And those are the things that really, well, obviously you can't. The human body wouldn't live without one or the other. But so that's what they did. And so the Fed came in and shored that up. And whether it's a temporary fix or lasting, we'll see. All right, what I want to get at is where we were back then on that low on March 23rd. So again, for about a week or so, I made it as clear as I could in these videos that the risk reward was no longer favorable for shorting or staying short. But if you recall, and what I'm looking at, I'm trying to compare today with this flip we've seen to people that a lot of comments, people thinking, okay, well, don't fight the Fed. The Fed's got this market, or Corona's over. this company or that company has this drug that's working now. That's the latest. I don't know, the latest buzz. Was it one of those companies? Let me see who it was. There's so many out there. I think it was Gilead now, and positive results there. So that's the latest buzz, just driving the market. But so what I'm talking about here is how things looked at the bottom and how everybody thought, there was no light at the end of the tunnel. But that's when you want to be getting long and at the very least stop shorting. So let me just make it very clear. What I've been saying for about the last week holds just as true today. I think the risk reward, the upside potential in this market is very limited, extremely limited in my opinion, compared to the downside potential. And that's it. So I cannot guarantee anything. I can't guarantee if the market's going to drop from here. I can't guarantee that it's not going to go up anymore from here. But I can tell you that I feel very strong that the upside potential is very limited at this point, even with the Fed maybe overdoing what they've done, the amount of money they've thrown into the market. Just like at that point, the downside was limited, and then the very next day is when, even before then, on that day we bottomed, I was already showing you the divergences and some upside targets. And then, as you can see, on the March 24th, the day after we bottomed, that was it. Everything. You didn't see a single short trade or a single short setup, only long side stuff regarding the equity markets with these targets, and this is what I want to talk about. So this was, back on the morning of December 24th, day after the market's bottom, broke the small wedge, gapped above it, and had this third target up here at the time of 273.57. And let's talk about that real quick. Let's go to what happened since then. So on SPY, that was a 30-minute chart, but I think I have it on the 60-minute board too, right here. And that was it. That's that same level right here. And so that was good for a bounce off the bottom of, I think, 25%, if I recall. Yep, 25% right there from the move. And so far what happened is I underestimated. That was, what I figured would be a maximum upside, bear market rally. And at the time, I said a couple things, and I said this at least once, and I think several times back then as we were bottoming in the markets, that I said, mark my words, you are going to feel very bullish and wanting to go long at the end of the next bear market rally. I've traded through bear markets, and I know exactly what they look like, what they feel like. And at the time, towards the top, it looks like, oh wow, we did dodge a bullet, and this market's going nowhere but up. And some you might be bullish and say, well, at least we'll get a correction. So what I'm holding here is we went up 30%. So that is was 5%. Again, doesn't mean we can't keep going up, but as of now, we exceeded that uppermost bounce target by 5%. So that's a 20% increase over a 25% return, 5% on 25%, so 1/5. So close enough. And again, now if we reverse, then I'm right. If we keep going up a lot more, I'm going to be wrong. But right now, this is what it should feel like at the tail end of a bear market rally. It should feel like nothing can take the market down. The news flow will be positive. That all goes hand in hand. That I promise you. The news flow doesn't go negative at a time like this. Everybody starts to get optimistic, thinking, okay, everything's good, safe to get back in the water. Corona was the best buying opportunity, another 2018. Hey, and it may prove to be. I would love to see nothing more in the market get back on track and head to all-time highs. I really don't want to see a break much below those recent lows, but I do suspect we're going to test them and at least come darn close to it. And at the very, very near term, forget about the long-term picture. Again, I feel strong that the risk reward right now for the next, let's just say, couple weeks here, a week or two. Or another way to spin it is and forget about time, because that can be tricky. Percentage is a lot easier. So I think from where we're at right now, I think the risk, the next, let's just say T3. Let's look at that. That's a 13%, 14% drop from where we are. So I feel strong that the next 14% move in the market will be to the downside before it will be to the upside. And I even think that there's a better chance that 14% drop being hit than the market going up another let's say 6, 7, 8%. In other words, I think the risk reward is it's not just the odds of us going down, but the percentage drop is going to be a lot more. There's a ceiling here. A lot of companies have been taking almost completely offline: airlines, cruise lines, hotels, restaurants. And again, at best, it is going to be a slow reboot, meaning you're not going to see, that's why I was searching for those pictures, anytime soon. You're not going to go to your favorite restaurant and have a 30-minute wait. You're not going to see people bumping in shoulder to shoulder, standing at the bar waiting to get a table. You're not going to see all the planes up in the air with crowded lines. I mean, the plane, they may start filling planes. That's an airline's goal, but what they're doing is they're not going to add back all the routes. When the planes start flying again, and again, I'm speaking, I know there's some planes flying, but I'm speaking metaphorically and generally, they're going to start increasing some routes. They don't want to fly half-empty planes. That's not cost effective with even though fuel's cheap. And so that's where we're at. So should we, what would it take for the market to go break to new all-time highs? It's going to take us being back to normal, being where we were right here when everybody was crowding into restaurants. They were filling football and baseball stadiums and concerts, and airfares were high, and you had to book way in advance, or your flight would be sold out, that kind of stuff. And so, right or wrong on where the market goes from here, one takeaway too is when I talk about risk reward, and sometimes not being certain of which way we're going to go, but when I'm adamant about the risk reward, in other words, right now the upside potential in the market, same thing in reverse back then. 29 days ago, Kyle Husky asked, you mentioned the VIX chart. Are you looking into trading TVIX? Stock is still having a huge run up, which I'm implying that means they're bullish and want to buy it. I don't know to ask. Seems like if we dig deeper into volatility, we may be able to get a good trading this week with TVIX. It's up from 300 this morning to now almost 1,000. And so, and without mixing any words, I said, we had an unofficial long trade on TVIX. It hit our final target for a 65% gain a few weeks ago. And I should have, in hindsight, I should have left that trade and let it run. But either way, we made 65%. We got out, and we didn't milk the whole run up. But as I went on to say, and I think this is important, and this kind of holds true to today, is why I'm doing this, because this is today in reverse. I said, regardless, the risk reward for entering a long position on TVIX here is nothing short of abysmal, in my opinion. In no way does that mean it can't or won't continue to rise. It simply means the potential for additional upside gains is dwarfed by the sudden and extremely large downside drop in TVIX, and quite likely a big drop that kicks off with a big gap that bypasses even the best placed stop orders. In other words, big risk, and really just horrible upside potential. At this time and going forward, the next trading opportunity I see in TVIX will be to short it. Couldn't make a strong case at that time. I said, the charts didn't have any solid sell signals, and I said I might not be able to get an objective entry on it if it reverses too much, but I can say that I would not go long TVIX at this time, and I'd rather watch it climb another 50% without me than risk being caught on the wrong side of a gap. And that was again, that was 29 days ago, and let's see where TVIX, let's see what happened to it since then. TVIX, there was our trade. We got in down here somewhere at the bottom. And 29 days ago, if we grab today's, you can see the pop-up box to the left should take us right here. That was it right there. So the day after it topped, that's when that post was made. And from there, TVIX has fallen from the high on that day to just the other day, or even we'll just look where it is today, for example, 78%, where it was the other day, a few days ago, 80%. So this is, again, risk reward kind of stuff, where and take that for what it's worth. And I see the same thing in the stock market right now. Now TVIX is of course a leveraged thing on volatility, and I went over time and time again. I showed a lot of charts back then how the VIX had peaked back where it did back in 2008, and I also showed you that the VIX can top as it did in the last bear market. The VIX peaked long before the market bottomed. So where the takeaway might be is, look, we're about to get another leg down. I think TVIX is looking interesting here. I'll say that. Look at the Got to be careful with these VIX ETNs. I know I'm kind of all over the place with what I'm saying here, but remember, this is an ETN, and especially those that track the more volatile an index, the higher the risk. Back in 2018, I think it was, early 18, 2 or 3 VIX ETNs blew up. One went completely away, meaning you lost almost everything. And it's just due to the nature of these guys. If you want to trade the VIX, you want to know probably, for lack of a better word, the safest way to trade it. What the professionals do is they don't buy these ETNs; they trade VIX futures. And if if you don't have a futures account, you can trade options on VIX futures. Those are, in my opinion, a little more secure than these ETNs. But the ETNs are easy, so I'll post analysis, and you can see right here we have the PPO starting to curl up. I use this PPO signal line, the 9 EMA, on a lot of stocks and indexes and sectors as a trend indicator, meaning when it's above the 0 line, that's this dotted line right here, dash line, the trend is bullish, and when it's below, it's bearish. And you can see and it often acts, that 0 line not only defines bullish and bearish trends, but it often acts as support and resistance when tested from above or below. As you can see here, 0 line came up and failed to get through, and we had a rejection. He had a cross here, and there was a little bit of a pop there, but that didn't serve so well as it really got you in too late. So I don't use it as a standalone buy and sell signal, but it helps to confirm the bigger trends. Here's a clear trend where we clearly put the 0 line, or the 9 EMA, the signal line above the 0 line. It's back testing from below. So this kind of meshes, or it does mesh or align with the analysis on the market that we have a sell signal pending right now, and I think it's probably going to happen today. I think this rally is a little overdone, and that's how they end. So let's get back to the charts and look at one I want to show you that really stands out are the futures. I know a lot of you don't trade futures, but I think you're remiss in not incorporating those into your analysis. Why? Because you might be watching something on, let's say, QQQ or SPY, and you get a sell signal or a buy signal, but at the same time that you have that, let's say it's a sell signal on SPY. You're looking to short. SPY breaks down, but then QQQ falls to a comparable support level, or NQ in this case, the NASDAQ 100 futures. But then NQ holds that support level and bounces. Then what's going to happen is that sell signal you got on SPY will prove to be a whipsaw, because SPY and QQQ, although they're 2 different indexes, they have a lot of the same stocks. There's a lot of overlap, especially on their top components. And so I like to, confirm buy and sell signals to see breakdowns on both of them. So when we get a breakdown below this is a very clean, well-defined uptrend line, and it forms this bearish rising wedge pattern here. We've been diverging, divergence is building, and I put an update. I updated this chart this morning. I put it in the comments section below today's first post. That first post only had SPY and QQQ, and so this is still the most likely path. We need that sell signal, not just a little. You might say, "Oh, Randy, I think we're below there right now." No, you'll know it when you see it. When you get a breakdown, you start to see impulsive selling, big red candle, a solid close below will certainly help. 60-minute close. It's a 60-minute chart, and this is probably our path. Down here, hit that first target, maybe get a reaction there, come down there, and ultimately, I think we work our way down here to 79.51. I mean, nothing's changed on that. I've been highlighting those targets and my expectation that we'll get there. Only thing is, we didn't have a sell signal. We've been walking up this trend line, and we had a couple chances to do it, but the market or index broke out. We had a little downtrend line here, popped above it. Remember earlier this week, held it, and rallied from there. But again, the technical posture has not changed, meaning divergences that have been building all along, and a trend line that we've been walking up. And so the way I see technical analysis, the way I believe it works, the more obvious a trend line is, the more likely you are to get traders that will sell when that trend line's broken, whether they're entering short positions or they're exiting their longs because they were riding a trend up. You get a combination of both. And so that's why I like to say, the better defined it and more obvious that level is, the more likely it's going to act as a sell signal that sticks once it breaks. So on that, on the same related note, I don't ever try to force levels. Or if I have a level and I'll say, here's a level, it's minor resistance or minor support or a minor trend line, and I put a little less significance on a more, well-defined longer term trend line. And that's kind of the case with ES. If I posted this chart recently, but you don't see I can't really draw a trend line with a very good fit. If I come off the lows, the same lows back here, March, around March 20th, March 21st, I come in, I only have a couple reactions there, and it is a trend line that may come into play, and I may add that to my chart, but it doesn't come in and capture the most recent lows. I can put a trend line here, and I think that's somewhat valid. There's a trend line right there, and they do intersect. So this is probably the more important level on ES, but I think once NQ breaks, it's going to bring ES down, because right now everybody's piling into the tech stocks, and they have been for a while, for all the reasons I said. I cited those fundamental reasons earlier, in this drop, that yes, they don't have, their business models are not as susceptible to stay-at-home orders and social distancing, because they don't have retail storefronts, most big tech companies, and tech companies in general. But however, they are, make no mistake about it, and this is what I continue to say, they are very susceptible to the business cycle, to consumer spending. The business cycle, when you refer to that in economics, you're talking about economic expansions and contractions. They're just waves over time, and they're as natural as the seasons. You're going to get them. What happened in 2009 to 2020, we had the longest economic expansion ever in history, because it was artificially propped up and induced by excessive money, free money, or cheap money, and excessive liquidity pumped into the system by the global central banks, not just the Fed, all the global central banks back in 2008, and they kept doing that. They took some of it back but left a lot of it on. So there's been a lot of liquidity sloshing around, and super low interest rates allowed companies that didn't even need to borrow money. They were cash rich, like Apple and a lot of tech companies, and they took that money and they turned around, because they could. They sold bonds at super low rates and bought their stock back. That's financial engineering. So that's what kept this cycle, the last cycle, going a lot longer than expected. But what I'm talking about is, now we've already seen we've seen one of the sharpest turndowns in history of the economic cycle. We've seen consumer spending, consumer sentiment. We've seen earnings. A lot of companies have stopped, and that's what's scaring me here. A lot of companies have, because I searched for it a few weeks back and I couldn't find hardly any recent profit warnings. Like Apple, remember a few weeks back when Corona just started, Apple gave a profit warning, and their stock dropped, and that triggered the slide in Apple. But since then, a lot of companies have refrained from even giving guidance, and so the market is just trading away like everything's hunky-dory. And I think whether it takes a few days here, or weeks, or even months for the market to realize, hey, the biggest fears, maybe we have hit some of the peaks in coronavirus, but now we have a recession to deal with, falling corporate earnings, and I think that's the next shoe to drop in the stock market, more so than probably a resurgence in coronavirus cases. Although with that being said, that is always a real possibility. I talked about that a few weeks ago in advance, that, hey, you're going to start to hear more and more about these peaks coming up in coronavirus, and I believed it would happen. Social distancing is not rocket science. You're not going to get a virus from somebody if you don't get anywhere near that person. You're not going to get a virus if you sit at home and nobody in your house has that virus. You will get the virus when you go outside, you go to a restaurant, you touch a doorknob, somebody sneezes or coughs nearby you. And so again, it is not rocket science at all. I had no doubt that we'd see those peaks, but my biggest concern now is everybody going to come a little too relaxed because the peak in cases, and how long will that take? And then once everyone starts going outside, if there's no real fix for this thing, if these panacea drugs, these cure-all things that are in the works right now, we all know a vaccine's a year away. Somebody posted a video in the trading room the other day, and appreciated it. Had a South Korean infectious disease doctor talking about this, and the official name for the coronavirus is SARS. I think it's CO92, something in the 3 letters in the middle there. And what that is, it's the second SARS. You guys, if you've been around for a while, you remember about 20 something years ago there was a big scare with SARS virus, and he brought up the fact, I didn't realize this. Guess what, guys? They've been working on a vaccine for SARS for over 20 years, and they still don't have one. So what happened is, it's not a big deal because SARS was contained, never really got out of control like this one. But just keep that in mind, that they talked about a vaccine being at minimum a year away on this one. Food for thought. It's very closely related to the first SARS-1, which still, to this day, 20 years later, they have not come up with a vaccine. I found that to be an interesting tidbit there. Okay, I'm done with my fundamental ramblings. Let me just give you the rest of the charts and we'll wrap the video up here. SPY, there's that big wedge on the daily. Trend indicator is still bearish. And then more importantly, again, that's long-term stuff. In very near term, I'm watching this trend line right here. This minor uptrend line. That's similar to the one I drew a second ago on the ES chart. You could probably extend it a little bit here. But remember, ES, you have a lot more candlesticks because ES is trading virtually around the clock, whereas you're looking here on trades that only occur from 9:30 a.m. to 4 p.m. Eastern time on this SPY chart here. So that's why I like to look at those future charts. It's like, I always say it's like having if you're a fisherman or a boater, sailor, the benefit of polarized sunglasses, or even an aviator, but more so in the water. That's where you can see down through. It cuts through the glare, and you can see objects, submerged objects under the water, such as fish or rocks that you might hit in your boat. Where you put on a regular pair of non-polarized glasses, you can't see those things, and that's why I like to use the futures, because it's showing me levels that traders have batted around, buyers and sellers, 2, 3 in the morning, 7 p.m. at night, and you have a lot more candlesticks, so I can pick up some levels that I don't see sometimes in SPY and QQQ. So that's it. Let's not beat a dead horse. That's it. There's or wedge, and by the way, the wedge is fully ripe and mature. Markets are still at or near some pretty significant resistance levels, and that's it. My outlook hasn't changed. I wish I could tell you it would, and I can see that from the comment section yesterday, a lot of people's views, and I'm seeing a lot of capitulation. And not to come off wrong, but I actually like that. I feel better, because before we never really reached that point, and I think that's maybe where I started shorting this a little too early. Is I think too many people were looking for that leg down, and to really get, and we're talking if this is a major, which so far appears to be, if we're going to take another leg down, a major bear market rally, you don't get the top, just like you don't get a top in the market until you have that almost all one-sidedness. Everybody's bullish and can't see any reason that the market's not going to continue to go up higher. Back here, all economists and market forecasters had the markets going up through, and no recession in sight. There was nobody, very few if any, had a recession priced in sight or a bear market back then. And you kind of need to get to that one-sidedness where you have the majority of people bullish, very low short interest, very low put to call ratios. Oh, and then somebody asked me to talk to that. Let me pull the put call ratio up real quick. Okay, and I hadn't even had time to look at them before this. This is a CPC, the put to call ratio, the total put to call ratios. You have indexes and individual stocks in here. And then you can look at the equity only or the index only. We will. Here's the thing. There's no takeaway. We're back in the middle of the range. You can see on my put to call rate, I've had these levels here for many years. I have a green line at what I call the buy level right there, about a little shy of 150. And all these, you can see when we hit that level, this is what the dash line shows you, and you can see the arrows. I haven't updated this yet, but there was our last buy signal, and that was another reason back then, and I talked about it. Why the market was probably not going to go down much more, because we had too much put buying compared to call buying, too much shorting, too much bearishness, and it puts a floor regardless of the fundamentals. So in the very near term, excessive bearishness and put buying and all that, it just likewise, if you get down here to these sell levels, you can see, and we haven't hit one of those in a while. So the takeaway is, all I can tell you is, look, This has moderated to a point now where the excessive fear, the excessive put buying compared to call buying has been cleared out. And that's been now for a couple weeks. So there's no hard number here. I can just tell you we've now come off those levels where it opens the door for a drop if we want to get it. Doesn't guarantee it. Like I said, we'd have to hit this level, and you're probably not going to hit this level. You're really not going to get here, I don't think, in a bear market, probably for a long time. So I just want to say from this, it gave us a good buy signal, Old Faithful. Look at all these other times it hit that level. And again, I've shared this chart many times in the past, so these are all things that kind of came into play there. But right now, there's no really predictive value from this, other than we've abated enough. We've come off those excessive levels enough that opens the door for a drop at any point in time going forward right now. And there's the CPCI, which is the index put to call ratio. So there's your S&P 500 index, things like that. And you can see they're really not, they're in no man's land in the middle, not telling me this is my buy line down here. I don't have a hard extreme line there. And then the other one that I have is the CPCE. Let's see if that's telling us anything. You know what? This chart, something happened to this chart. It quirked out. So I have to replicate that chart, recreate it. Here's what it looks like. I don't have it annotated because I'll have to recreate this chart. But we did hit an extreme recently. To have a line, it would be somewhere in the right there. That's probably where I had the line before on it. Those are the points when you get to that line. That's where you want to step in and buy. If we hit an extreme down here, that's pretty much your extreme. We haven't hit that in a while. That's usually where you want to sell when things get a little frothy. But again, we're kind of back towards the lower end of the range right now, which opens the door. It tells me that people are a heck of a lot less bearish today than they were just a few weeks ago at the market bottom. And so that does open the door. That doesn't guarantee, but it opens the door for another big leg down in the market, because we don't have that put protection in place where everybody's loaded up on puts and everybody's short. And you can go, the short interest in the market probably goes roughly hand in hand with this as well. It only makes sense if you're going to see a spike in the put to call ratio. You're also going to see a spike in short selling. And unfortunately, with short interest data, these numbers are done on a daily basis. This chart, you can go directly to the CBOE site and get intraday real time. They update about every 30 minutes, I think, on that site. But where I was going with that is short interest, unfortunately, is so lag behind. They only report it twice a month, and then that's when the numbers are taken, and then there's a 10-day wait time or dissemination period after they get those bi-monthly readings. So by the time you're getting the short interest data from the exchanges, it's, especially in this fast-moving market, it's way dated. It's not even useful in a fast-moving market like this. So what I do with that is I kind of get ahead of it, and I can just extrapolate or kind of guesstimate how much short interest has dropped off. And you can look at things like this, and you can just simply look at the rally in the market to tell you that there was a lot of short covering here, undoubtedly. So let's wrap it up here, guys. Long video, but there's my thoughts, and waiting for those sell signals, which should be soon. Here we go. We're starting to crack right there as I do this video on the NQ. So if we go much below that, 87.30 by the time you watch this video, and on QQQ, same thing, big 60-minute bearish rising wedge right there. We had a little whipsaw, but remember, SPY held above support, but now we're cracking again. And you'll know it if we get it. You'll start to see increase in the selling, a little more impulsive. Otherwise, we're still a little too close to say this is a breakdown yet, especially with SPY still being above trend. In fact, you can even pull that trend line down there and just say, okay, we need to see this go with conviction. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.